Good evening, friends. I welcome my audience and clients to this very special edition of our webinar. Today, we have with us Mr. Sunil Singhania, founder and CEO of Abacus Asset Management Company, a market veteran. He is accredited with taking Reliance Capital Group, Reliance Mutual Fund to where it is today. Uh, not wasting too much of time, can we have Sunil online, please?
Thank you, Ashish. Thank you for having me here. Good evening to everyone.
Welcome, Sunil.
Welcome, Sunil.
Welcome to the
Welcome to the
webinar.
webinar.
So,
So,
Sunil, not
Sunil, not
wasting too much of
wasting too much of
time,
time,
I would
I would
straight
straight
ask you a few
ask you a few
questions.
questions.
Good times,
Good times,
generally,
generally,
nobody needs any
nobody needs
advice.
any advice.
I'm sorry,
I'm
I think
sorry, I
my
think
voice is
my
echoing
voice
a
is
bit.
echoing a
We
bit.
are trying to
We are
sort
trying
this
to
out,
sort this out,
but I would
but
want
I
the
would want the
audience to
audience to
just
just
bear with me.
bear with me.
Sunil,
Sunil, so
good
good
times
times
generally don't need
generally don't need
advice, but yeah,
advice, but
when
yeah,
the
when
times are
the times are
difficult, that
difficult,
is when
that is when
most of us
most
scramble
of
for
us scramble
advice.
for advice.
You have
You
been
have been
seen all types
seen
of
all types of
markets. You've seen
markets.
bear
You've seen bear
phase, you've
phase,
seen
you've
bull
seen
phase,
bull
and
phase, and
probably many
probably
times
many
over.
times over.
No better
No
than
better than
you to
you to
guide us
guide
on
us on
how the
how the
markets will be.
markets
So
will
my
be. So my
question to you
question to you
is,
is,
where are
where
we?
are we?
What is going
What is
on?
going on?
चल क्या रहा है
चल क्या
सर?
रहा है sir?
No, so Ashish, you're right. In good times, we get tips that what we should be buying rather than the other way around. But having said that, I think last 2 years have been very eventful. We started with deep despondency and a lot of scare in 2020 when COVID hit us. And I think as things progressed, as mankind's we evolved, and then we reached a stage in towards the end of 21 where everyone became super bullish. Obviously, by nature, all of us want to be positive, and that's a good thing. But we became a little super bullish, and at least in some of the pockets, whether it was the IPO market, it was this new age, new tech companies, some smaller companies, there was, I would say, not euphoria, but I would say over expectation, which was getting built in. And on the other hand, you had the world which was facing a lot of headwinds. You had the China issue, where the education companies there got hammered due to government intervention. You had the Evergrande issue, and therefore the real estate sector got hammered. You had concerns obviously emerging from the inflation side, largely because all the commodities went through the roof. And then obviously the central banks all over the world had to come down, and there was this interest rate increase. Amidst all this, what was left got filled up by the Ukraine and Russia issue. No one expected it to evolve into a full-blown conflict. And I would say after decades, we have seen such a phase where two countries are actually in a long drawn kind of a 3 month old war. So culmination of all this, and markets also needed some reason to sell off. Plus, foreign investors have been constantly selling, and I think that is the reason why we saw what we saw. The good thing is that we as the investment community react very fast. I think over the last 6 months, Nifty fell by a high of 15%. We have recovered in the last 3 4 days, thankfully. Almost one third of that fall. We are back to like less than 10% lower as far as Nifty is concerned from the all-time high. But select stocks are down anywhere between 15 to 30%. And I think that is where the pain to retail investors is. But as I said, we have already discounted a lot of stuff. So, US yields rising from 1.2 to 3.15 back to 2.75. Commodities have reacted 10 to 15%. Central banks have started to increase interest rates. And as we speak, I would say the most of the increase which is going to happen in the future seems to have been discounted as far as the price is concerned. Earnings have been very good, though the reaction to the earnings have been ruthless. So if you declare good results, the stocks fall by 5%. If you even miss by 2 3%, the stock falls by 20%. I think that has been the ruthlessness as far as the markets are concerned. But I think it's a process, and we have seen this many times earlier also. From an India perspective, earnings continue to be pretty decent. Some companies, some sectors got impacted on the margin front, but I think overall, as corporate India, earnings are trending upwards of 20-25% as we speak for the current quarter. And we are almost coming to the end of the current quarter earnings. And even for June and for the year FY23 and 24, earnings are looking decent. As I said, some companies, some sectors will have margin pressure, but luckily the top line growth is looking very good. The other thing we have to remember is that earlier, whenever we used to have some issues, the country used to go for a toss, tax collection used to go for a toss, banks used to have NPAs, companies used to go belly up, currency used to go down by 10-15% overnight. I think this time all the other factors are pretty positive. Tax collections are at a record high. Rupee has been one of the most resilient currencies in the world. Corporates, when you speak to corporates, no one is complaining about top line growth. Yes, there is a little bit of pressure on margins, but demand scenario, no one is complaining about. And both the urban economy and the rural economy. Urban economy, because of the great job scenario, increase in salary levels, particularly for the IT guys, and rural, a mix of good agricultural produce and good agri prices across board has ensured that for the next 6-8 months, the demand scenario continues to be very good. The only worrying factor, frankly, Ashish, at this point of time is the crude price. Our view is that crude should fall to $70-80, but we have been wrong. I think the last 10-15 days, crude has again moved to almost $115-18, and I think that is one factor which we need to worry. In conclusion, I would say that near term volatility is there for sure. We are not seeing a fall below the recent lows which we see. At the same time, we are not seeing a very quick move towards an all-time high. I think crude is going to be the deciding factor, at least for Indian markets in the near term. Any sharp increase in crude prices, the probability of which is very small, might lead to, again, some correction. And on the other hand, if crude, hopefully, thankfully, God willing, does correct, then I think India will stand out as an economy which is the best placed. And therefore, our view is that from a medium to long term perspective, things continue to be as positive as they ever were. I can't hear you, Ashish. I think you're on mute. Yeah.
Actually, my voice is echoing, so I'm just being a little careful. Sunilji, just you touched upon a lot of variables. Market में volatility I think happens most of the times when variables are not known. Now most of the variables are known. There is a war which is happening, probably it is taking some direction. Easy money policy is now over. Most central banks are tightening it. Inflation is going up. Interest rates are going up. There's a talk of recession. But why then so much of volatility? Generally, what we see is volatility comes when variables are not known. So, looking at the volatility, do you think we still don't know a lot of what is going to come? Sunilji, sorry. Yeah.
Yeah. Huge volatility, you're right. Huge volatility comes when there are unknowns, and this time there have been knowns. However, this volatility has come also because of the global volatility. So if you see US markets, the Nasdaq has moved up 4% in the last 10 days, almost 4 days, which has never been the case. Also, the currency volatility, I'm talking about global currency volatility, has been huge. So US dollar went as high as 105, the dollar index, and now it's trading at 101 too. Yen is like a 10-15 year low, and so on and so forth. And I think this whole world has basically been on a roll last 1 or 2 years. We have had new types of investment like crypto and all come in. We had new age businesses which do not make any profit, which we don't know whether will make profit or not, but which were under fashion. And most of the volatility has been in these asset classes where fundamentally you could not prove anything or value anything. And when fundamentally you're not clear whether the stock or the asset class falls 20, 30, 40, 50%, you're still not clear what the value is. And that volatility has rubbed on to other sets of companies or asset classes. I think luckily for us, at least, we are very fundamental focused. So we also have borne the volatility, but the volatility is much less. largely because we are dealing with known unknowns rather than unknown unknowns, as you rightly put in. So I think this volatility has been more because of a lot of fashion-based investing or FOMO-based investing, and I think it will find its own levels.
Sunilji, a little bit on the Q4 results. You touched upon the results as well, but what we are seeing is that while the top line is going up, you don't see the top line resulting into the bottom line. Margins are kind of contracting. So, how do you see broad basis? How do you see these results? And do you think there are any sectors which are more resilient than the others? So, a little bit on the results and a little bit on the sectors.
So I think you are partly right and partly not right. So yes, there have been some companies and some sectors which have had margin pressures coming in from three main reasons. One is huge input cost increases. So whether you are a consumer of metals or consumer of chemicals or consumer of anything, you have seen the worst because already there was inflation, and after the war prices in some commodities really went through the roof. Second is energy cost went up dramatically. So petrol and diesel prices, gas prices, coal prices, across the board there has been massive increase, and particularly for sectors which are power intensive, like cement or even some building materials. I think you could visibly see margin pressure. And third is logistics, I would say upheaval. So we all know that China has had a COVID issue, and for 2 months, almost the entire country was under lockdown. They've just recently opened up. Today also, they've opened up further. And as a result of which, logistics cost went up dramatically, and availability of goods also was an issue. So for auto, for example, chips and semiconductors were an issue. So is the case with a lot of other electronics and so on and so forth. So, Ashish, in a way, I think the March quarter was a really tough quarter. And I think to some extent, the June quarter is also going to be equally tough in terms of input cost increases and so on and so forth. Luckily, a combination of two, some respite in all these input costs and some passing on of this cost increase to the final consumer would allay some of these concerns. But despite what we have seen in March, I think if you see overall corporate India, the profit growth is going to be upwards of 20, maybe 23, 24%. I think after tomorrow, which is the last day of the earnings season, we would have compiled it. As of now, earnings are trending up almost 20 to 23% higher, led by a few sectors. So obviously, IT has done pretty well, despite margin pressure led by salary increases. Banking has been the rock star. Across the board, banking has done very well. Again, a combination of NIMs expanding a little bit, some increase in credit offtake. I would say that as we move forward, the credit offtake would only strengthen. And also helped by very low provisioning, because last 5 6 years, corporate India as a whole has cleaned up its act, and the NPA accretion for banks have been very low. There have been pockets of other, I would say, increases. So commodities has had a great quarter, and as we move forward, except steel, I think the other commodities should continue to do well in June. Steel, obviously, the government came down with some export duty, and there would be some impact. But other bits and pieces sectors, select consumption plays, rural focused consumption plays, they have also done quite well. Some smaller sectors like, paper, for example, which was not doing well, has done well. So some sectors have got impacted, but some sectors have benefited. One sector which has done very well despite the general perception of headwinds has been engineering. So you have great top line growth of almost 20-30% even for large companies like Siemens and ABB. And on top of it, despite the headwinds in terms of raw material cost, they have been able to maintain and in some cases even improve the margins. And that clearly shows that the capex cycle in India is also again looking pretty strong. So, giving a disclaimer that we are always positive and optimistic, I would say that overall the earnings season has been pretty decent. I can't hear you,
Could
Ashish,
you-
again.
Sorry.
Yeah.
Am I? Can you hear me
Yeah.
now? Okay. Sunil sir, so my question to you would be, if results season has been so good, not that bad, and generally variables are known, FIs क्यों माल बेच रहे हैं? Why are they selling the way they are selling? And yeah,
Yeah. Okay. I think FIs in see the FI outflow actually started towards the end of 21. What happened was India was an outlier. India was rocking, doing very, very well. I'm talking about the equity market performance now. And China suffered massively, where the stocks like Alibaba and all went down 50-60%. Overall, Chinese markets were down 20-30%. And normally it happens, you sell your winner and double up on your loser. I think that is what happened with the foreign investors also. They booked some profit from India and put money in China. It did not work, but we got outflows. I think the outflows were tapering off by January end, and then Russia and Ukraine happened, and oil went through the roof. Before the war, oil was at 75-80 dollars, and then suddenly at 30-40 dollar jump. And logically, whenever oil moves up, there are investors who get a little bit cautious on India. And on top of it, you had a scenario where dollar was strengthening, yields in US went above 3%, and there was a total risk off. So what happens is when dollar is so strong and when dollar yields are like 3%, I think money moves away from so-called risk assets, which will include emerging markets, into US. And I think that is what happened. There was general sell-off in emerging markets. There was slightly more sell-off in India because obviously even uh, till February, March, foreign investors from a 1-2 years perspective were making much higher returns in India than anywhere else. And I think we saw the selling the way it is, and I think it is very, very surprising. No one expected FIs to sell 2 lakh crores worth in like 6 months. More than 2 lakh crores, in fact, in 6 months. It has never happened before. Most of the selling was in two sectors, banks and IT. Because foreigners have almost 55 to 60% of all their investments in India into these two sectors, and they are very liquid also. If you want to sell 100, 200, $500 million, you can easily sell off. Last 4-5 days we have seen, starting with banks, banks have started to consolidate. The fall has stopped. In fact, bank Nifty was the first to show an uptick, and then the Nifty happened. And even in IT, last 2-3 days we are seeing that. Our view is that actually, if you see the global scenario, first of all, with dollar weakening, money has started coming back into global equities. There was a $21 billion inflow in global equities last week. And second is, even from a global investor's perspective, the options available are reducing. China obviously is a pariah. It's just like it's a beware kind of a country. Russia is now a sanctioned country, so no new flows will go there. There are not too many large emerging economies left for foreign investors to invest. So I would say that imagine their view on India becoming positive, then what will happen? So you have domestic investors who continue to be positive, and then if global investors also become positive, the uptick can be really, really sharp. I like to bring one point again, which I highlighted earlier. Crude is something which we need to track. Sir, agar God willing, अगर crude 70-80 हो गया ना, then you are looking at a really, really very, very different scenario. फिर ऐसा लगेगा अरे यार मई में अपॉर्चुनिटी मिला था, हमने क्यों नहीं किया था.
Sunil, you referred to in your first reply. You referred to e-commerce companies, these Zomatos of the world, Nikas of the world. All these e-commerce companies generally we see they touch our lives more than many of the other companies listed on the exchange. Uh, we see read articles about PE money kind of drying up a little bit on the growth stage. So, what is your sense on these e-commerce companies? Do you still think that there is value in these companies? How should an investor approach these companies? Just to Understand. So you're on mute, I think.
The host, I think, I'm sorry for that. You can hear me now, right?
Yeah, yeah.
Okay. So these are great companies. They have created great businesses, and from an Indian economy perspective, I think hats off to them for giving the customer so much ease and comfort. And even from an employment generation perspective, hats off to them for creating lakhs and lakhs of employment as far as India is concerned. Having said that, not all business models will end up making money. So right now these companies are in the investment mode. Obviously they would be having a plan to definitely turn positive, and I think one of the companies you referred has given a good indication last week, and that is the reason why from the low points they have moved up 20-25%. However, from our perspective, we are a little bit of a traditional investor. We do like growth, but we invest in companies which make profit, where there is visible profit growth, and what you pay today is going to be more than repaid by way of future profitability. You touched upon the fact that the PE funding is drying up a little bit. I would not say drying up a little bit. Obviously, when secondary markets fall, everyone becomes cautious. But you are right. These are companies which the PE kind of investors understand. In secondary market, investors don't understand these companies beyond a point of time, and particularly in challenging times like what we saw over the last 2 3 months, we know what happens, because these companies you cannot track on a quarter on quarter basis, and unfortunately the moment you get listed, you are going to be tracked on quarter basis. So I think the investors who would be investing in these kind of companies would have a very different mindset. And I would really urge everyone who's on the show that don't get into anything just because everyone else is getting into it, and because of FOMO, which is fear of missing out. If you don't understand the risks associated with these companies, please stay away from them.
So, bit on advice to our customers. uh, Fear, this fear, थोड़ा डर है, there's थोड़ा people are doubting themselves, a little bit of confusion, as I will say. What will your advice be to our clients and investors who are on this call? uh, will you say cash pe बैठे रहो, or will you say little bit of convert your portfolio into little bit more of cash, or go all out, or is the answer somewhere in between?
So $1 million question, and I wish I knew it, and I wish what I say will come true, which has never come true. But see, Ashish, I'll give a very simple example. In US, year to date, which is 2022, fixed income investors have lost more money than Dow investors. I'm not talking about Nasdaq. So it is not that easy that you move from equity to fixed income and you'll make a lot of money. And it is also impossible for you to keep on moving. Like if you did not invest last Wednesday, you have missed 1 year's fixed income returns in the last 3 days. You know, Actually 6% is like 1 year's return. In the last 4 5 days, you have missed 1 year's return. So it is very tough. The other thing is, I always believe that an equity investor has to be a positive and an optimistic person. If you believe that tomorrow is going to be better than today, then only you invest in equity. Otherwise, please don't invest in equity. I would say don't invest at all, just spend the money. The banks like Kotak will chase you. You can have a good time. So you have to be optimistic. And the other thing is, it is impossible to know what factors will pan out in what way, because the world is very dynamic. See, there is no expert in oil who can predict whether oil is going to be $50 or $150. Those who are experts do not predict that oil will be negative. And when oil was negative, there was not a single person who said that oil within 2 years will be back above 100. They were all talking that 40 is the maximum will oil go. And similar is the case with so many things. No one expected Putin to do what he did. and there are maybe 10, 20 of such characters in the world. You never know. So I think we are in a very uncertain kind of a scenario, and therefore, near term, you have to get over this tracking on a day-to-day basis, get over the fear, get over this, daily multiple factor analysis. Uh, you know, there are 180, 200 countries. Each country has 200 factors. If you tick mark all the 40,000 factors, then by the time you invest, Sensex will be 5 lakh, you know. So there has to be some call you have to take and some risk you have to take for you to be an equity investor. So I would say that if your horizon is 3 4 years, we are very sure that even from these levels you will end up making 15 17% return year after year.
Sunilji, I know that you track data carefully, and these days data availability has become a little easier than it was 10, 15, 20 years back. पहले वो आई थिंक घर पे एक बुकलेट आती थी एनुअल रिपोर्ट एंड दैट इज व्हाट पीपल हैड टू रीड बट नाउ आई थिंक you get structured data on various sites giving a lot of data. But unfortunately, companies that make profit go down, companies those are making losses are going up. So I'm saying, can you give a couple of ideas or tips to our investors on what are those two, three things to track? One, two, three. When you look at the financial results, what are the three things
So
that you should look at?
I wish I could do this in 30 seconds. It has taken me 30 years. But see, I'll tell you, Ashish, there are different investors who look at investing in very different manners. And there are a lot of very smart investors. And different investors have a different perspective and they're successful in their own way. Some investors, would say that we only invest in very high growth companies. We don't care about profit. Some investors are there who would say that we invest in good companies. We don't care about valuations. Some investors would say that no, we will go into only deep value companies. Our view is that growth is needed. Without growth, you will not make return. But what you pay for growth is very important. So for us, the best company is not the best stock. For us, a good company with a good valuation and a decent growth is a great stock. And if there are not too many investors into that company because the company is not being tracked, that is the best sort of combo you can get. But the only thing is, in these kind of scenario, you have to bear the drawdown of 20 25% which can come in. And you should also have a 2 3 4 years perspective. Coming to your basic question, see, the one thing which I can mention here, obviously, analysis is not only mathematics, it's also a lot of art and science, but cash flow is very important. I think a company which makes cash flow and which makes profit rather than shows profit, which gets reflected by the cash flow in the balance sheet, is the most important. Being a traditional investor, as I said, for us balance sheets are very important, and I think balance sheets give you 90 95% of what you want to know about it. But it's a topic where we can basically have maybe a 2 day seminar rather than a 1 minute or a 2 minute answer.
So I think the cash flow, what you said was, I think, precise. So long as the profits are coming, is followed by the cash flow, I think it's a great company to buy into. So one more thing that a lot of investors ask me, and I probably don't know how to answer them, is a lot of advice coming on Twitter, on WhatsApp, and everybody looks like a research analyst guiding others on what to buy, what not to buy. And sometimes when I look at Twitter, also I feel, ke, am I making the right kind of money, or probably I'm losing out? So I don't too much noise. And how do you think investors should filter that noise? What should be the way they should approach the
So frankly,
social media?
in bull market, when you see Twitter, कभी कभी लगता है that we should retire because everyone is making 200% return. But if you actually see, you tweet 5 times a day. After 100 days, you have 500 tweets. and then on the 101st day, you highlight the tweet which has worked and ignore the tweets which have not worked. But as I said, we are in a connected world. Everyone wants to be up to date on a second to second basis. There is also a thrill in negative news. Uh, you By human beings ever, you like to see someone else suffer. That's human nature. And therefore, the impact of negative news on Twitter or on other medium is very, very high. And I'm very sure guys like Trump and Elon Musk will subscribe to that also. Then there are various chat boxes and various WhatsApp groups and Telegram groups and XYZ groups. So I think there is a lot of clutter. I think investors over a period of time will automatically filter out and automatically adjust to it. अभी सब नया नया है. अभी there are a lot of, and the markets was such, आपने कोई टिप दिया हो अगले दिन 20% ऊपर है. So that when you see success, you start to believe that, and therefore the following increases, and therefore the impact increases. Now we have seen the drawdowns, what we have seen over the last 1 month. You need 2 or 3 of such kind of periods in the market, and I think investors or traders would understand, that all noise is not worth acting on. आप पढ़ो, मजा करो उसमें, but everything if you start to believe on, you will end up buying at the wrong time and selling at the wrong time. And uh, in a like I would say in a lighter way, you know people who are smart, they don't need to tell you how smart they are. People will automatically know. So if someone is self propagating on social media, they are only going to tell you all the right things they have done. No one is going to say that I made a mistake in this. And I think that also we have to be very careful about.
Thank you, Sunil, for the word of advice. I think my voice has started echoing again, probably. Um, so coming back to the portfolios, I'll start with before I discuss on specific portfolios, a little bit on the name Abacus. My daughter used to learn abacus, some classes. She had a calculator and कुछ वो mathematically ना calculate करती थी. I used to ask her how do you add 385 to 586, and she used to give me an answer very quickly. So I'm thinking my knowledge of abacus is more that calculator. Wanted to probably understand what do you want the investors to gather from the word abacus.
Obviously, very dear question. So you are right. ABACUS is basically the first instrument developed by mankind to help us in mathematics. And if you see the tagline of Abacus, it is believe in the basics. So we basically believe in doing work which is very, very basic. There was a little bit of modification done. So ABACUS became ABAKKUS, just to bring in a little bit of personal thing into the name. So they are the initials of my family members: Kanchan, Khushi, Ujjwal, Sunil. So you have Abacus, which is the basic instrument to do calculations. Our tagline is believe in the basics, and the modification was to just bring in something personal into it.
Yeah, that's great, Sunil. I'll now come back to a little bit on the specific portfolios that we wanted to talk about. I will invite Rahul on the call. Rahul manages the Premier League portfolio. Can we have Rahul on the screen, please?
Good evening, everyone.
Hi, Rahul. Welcome to the to the webinar. So,
Hi,
Rahul,
Ashish.
direct question to you. What is this portfolio all about? Can you just help us with a little bit of what are the constituents, what's the construct, what are the sectors, structure, so a little bit of the portfolio. This
Sure,
is the, yeah.
Sure. So Abacus Smart Premier League portfolio is a long-only Indian listed equity strategy that we follow for this portfolio. It predominantly invests in top 250 companies sorted by market cap, with select smaller companies to generate alpha. The fundamental bottom-up approach stock picking is followed with the help of our team here. It is benchmark agnostic diversified portfolio. Now, in terms of the endeavor to generate alpha and wealth creation, with typically 3 to 5 years of holding period for the portfolio.
So, Rahul, a question to you: what is the mid cap, small cap, large cap ratio? So, slightly, a little bit on how many stocks do you choose? How do you rebalance this? How frequently you rebalance this? A little bit on that side.
So it's an actively monitored portfolio. We endeavor to have rebalancing once in a month or probably or once in 2 months, but it depending on the idea flow that is coming through. Typically in the portfolio we have 20 to 25 stocks, and in terms of select stocks, none of the stocks will be going more than 10% at any point of time by weightage. And in terms
Okay.
of the sectoral exposure, will not have any sector more than 30% at any point of time in the portfolio.
Is there any specifics on how much large cap and how much mid cap?
So largely it's going to be top 250 companies with select exposure to the small cap and mid cap companies. As of uh, as of 31st March, the exposure to large cap was 65%. The mid cap and small cap was 35%.
Okay. Rahul, one more question to me. Why do you think this portfolio can create alpha over the broader market?
Right. So we
Just
have a
one, yeah.
specifically MEETS framework that we follow, where a MEETS stand for M for management, where the quality of the management and the capability of the track record is checked throughout the history. In terms of the earning, we see the quality of earnings versus the reported numbers, and there is a structural or a cyclical earnings growth that is visible over the next 3 to 4 years, and events or trends that are possible where we can have an opportunity in terms of valuations. And if the structural opportunity is going to be available over the next 3 to 5 years, so actually if we keep our mates framework in the process that we follow, we believe we can generate significant alpha over the markets.
So, Rahul, just once again, so meets framework. So, I understood management. So,
Right,
quality of management, of course, is number one.
right.
Then you said meets double E. So, first E is earnings, if I am not
Yes,
wrong.
right.
So, earnings have to be there. That's done. The third E stood for
Events.
events. So,
Yes.
a little bit
If
more
there
on
is an
events.
event on, yeah, if there is an event on the horizon, or are there any disruptive trends or new themes that are coming up? So some of the events are equally important where we have a deep dive into the assets.
Okay. And now we are left with a T and an S. So,
Right.
T stands for,
So T is for timing. We believe that
okay.
every good company is not necessarily a good investment if the price is not right. So what is the price discounting? How will the time frame of the what is the time frame horizon for the investment? So we have to assess multiple variables at that point of time. And
So, I think,
Right, and S stands for the structural thing,
okay.
competitive positioning, the more consistent growth in profits, and the size of the opportunity.
Okay. 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 No, I think Sunil also touched a little bit upon broader things when I was asking him questions. So I think that framework will definitely help this. So how many? I think just to go back, this portfolio has been there for some time, and I know a lot of our investors have also invested into this portfolio. So just to see in last 6 months or probably last 9 months, I think we started this somewhere late last year. How many times the rebalancing would have been done? Is it been monthly or it has been probably once or twice a month? So,
So over the past 8 months, we've done four changes as of now.
okay, okay. So you have exited out
So
from one stock or and bought into one another stock or probably also kept cash with you.
we largely don't take any cash calls,
Okay,
but it would be by chance.
okay. And these portfolios still have some cash component in the construct right now. Do you have a right now? Are you holding cash?
As of now, yes.
Okay, okay, okay.
So
Sunilji,
Ashish,
any thoughts
this
from
is
your side?
Sunil
Yeah.
here. So I think by design, we have not wanted to keep very small companies in this portfolio. And I'll give you the reason. One is, it is a advisory portfolio, and smaller companies, the moment you recommend, there was a time when stocks were just going berserk, upper circuit 2, 3, 4 days. It was very difficult for investors to even execute. And we didn't want a scenario where paper में आपको return दिखता है, but investors have not been able to do anything. The other thing, it's a new concept, and we don't want investors to get into it with a very high sort of impact cost, both on buying and selling. So I think for now we have restricted. I think 80% of the portfolio would be in the top 250 companies, right, Rahul? That is how we have structured it.
Yes, sir. Ashish sir, you're not audible.
Because of this echoing thing, no, so I am a little careful in just keeping my phone on the speaker on mute. Sunil ji, I'll come to the Build India portfolio a little later. But मैं आपसे समझना चाहूँगा अगर मेरे पास 100 रुपया है, so how do you think I should allocate this money between these two portfolios, or how do you think had to any investor who's listening to this call, how do you divide the money?
So I think in the
So I think you've turned mute. Yeah.
No, I unmuted, but the host muted me. I don't know. Anyway, I think in the absolute near term, the Build India portfolio would be high beta. So I mentioned to you, engineering companies have done well, and by name Build India itself, it's a portfolio which is having companies which are predominantly into the capex kind of a cycle. So in the absolute near term, I think that portfolio would be higher beta. But when the markets fall, it falls also higher. So you have to be aware of it. The portfolio which Rahul runs is a portfolio which is very good from a 3-4 years perspective. I think the attempt would be that whether we can generate a reasonable 5-6% alpha over a similar kind of portfolio, So we don't intend to churn a lot, because again in advisory, churning is additional cost. Impact cost is very high. So unless there is a really a need, we don't churn. And some of our investors are really, I would say, frustrated with it. We keep on getting comments that why are you not churning? Because they like to see the thrill of it. So, our job is not to provide thrill. Our job is to provide returns. So I think if someone is looking for a really high beta portfolio, then Build India. Someone who's looking at a diversified, stable portfolio, then, the portfolio which Rahul runs, which is more the Premier League, that would be the case.
Sure.
So Premier League would be your, the Test cricket, and Build India would be at least in the near term, not T20, but at least 50-50.
Okay. Thank you, Rahul. Thank you very much. And I will now invite
Sure.
on the
Thank you so
webinar
much.
Chetan. Chetan manages the Build India portfolio. Can we have Chetan on the screen, please?
Yeah, hi. Good evening, Ashish, and everyone.
Hi, Chetan. How are you?
Yeah, hi. I'm fine.
Chetan, so a bit about I made Sunil talk about this portfolio a little bit, but I think coming from the fund manager himself, where do you can you just share a little bit about this portfolio again, the structure, the construct a little bit?
Surely. As Sunil sir mentioned, it's a, portfolio wherein we have mapped in our investment universe predominantly company considering of the companies which are going to get benefit because of the economic development. As a result of the four things, what we have mapped out is the potential investment in the infrastructure space. Second thing is the capacity expansion being undertaken by the company. The third one is the thrust on the domestic manufacturing. And lastly, the unfolding economic reforms which are being initiated by the government. So companies which are directly or indirectly getting benefited because of this, our investment universe will be constituting of that. It would not only be engineering companies, but largely it would be. But there would be other sectors which are benefiting because of the undergoing exercise, because of the capex activity being taken in the system. And it's a predominantly a benchmark agnostic portfolio. We are again wherein the company selection will be a bottom up, adhering to our mid standard, which Rahul went into quite detail. What are our mid standard? And again, the portfolio, the Build India portfolio would not be more than 25 companies, and no single stock will be more than 10%. And right now we are totally invested, so we don't have a cash in our books, and it's totally invested portfolio.
So, Chetan, there are about 25 odd stocks in the portfolio.
Right.
Again, this is not like the Premier League portfolio, which was choosing stocks from the top 250. You do not have any guidelines on the top 250. It can be across the spectrum. Am I right?
So that's what I started with our investment universe. We have charted out our investment universe. The basically the companies which will be getting selected will be like which are going to get benefited because of the capex activity being
Understood.
under the system.
But there is no specific. You have a list. You have
Yeah,
a.
yeah, we have our internal list. Yeah.
Chetan, what Ashish is asking is whether there is any market cap restriction. That is what he's asking.
Oh, is it? No, there is as such no market cap restriction, but generally it will be a mid to large cap companies, as to
Understood.
not to impact on the cost front. That's why.
Understood. Understood. And any broad time horizon, if somebody wants to invest into this portfolio broadly, what should be the time horizon? A year, 2 years, 5 years?
So right now, what we are recommending is broadly between a period of 2 to 3 years, wherein we invest in the companies and riding the entire tailwind of the uptick in the earnings. So we recommend at least 2 to 3 years of a investment horizon.
Okay, and finally, I asked this question to Rahul as well. What is
Yeah.
the kind of alpha we think that we can create in this portfolio over the broader market? I think Rahul gave me a figure of 5 to 6% over whatever. So I'm thinking just having a sense, probably a little more riskier than the other portfolio. So just wanted a sense on that as well.
Again, as what the sir said, the volatility in the portfolio would be quite high, and there are no as the comparable benchmark vis-a-vis wherein we can compare our portfolio. But as what we have seen, since the inception of our portfolio, wherein we benchmark, typically the alpha would be at least 600 to 700 bips higher than the broad industrial index or the Nifty infra, BSE infra index.
Okay, thank you, Chetan. I got a broad sense. Before I take a couple of questions, I have Sunil a few questions which the audience is asking. But before that, I would want to know some closing remarks from you on these two portfolios.
So, Ashish, there are a lot of obviously this smart case, well desk kind of portfolios in the market. I think some 500, 700, and a lot of these portfolios are also momentum based and mid and small cap based and so on and so forth. And obviously, we are known for stock picking, and therefore people must be, or investors must be expecting a lot of small caps from our side. But as I said earlier, this is a new sort of an investment vehicle available. We don't want a scenario where just because we want more investors, we get them into something where entry and exit is very difficult. And you know what happens in some of these portfolios. So we have a mix of alpha creation opportunities, at the same time ensuring that the volatility is not very high. I would say that these portfolios, again, as has been the case with every portfolio from a Abacus perspective, should be looked at from an investment perspective and not from trade perspective. I see a lot of investors who come in this, advisory kind of instruments wanting to trade a lot. I would say that our portfolios are not designed in that manner. At the same time, for example, Chetan mentioned Build India. Our view on the next 2 years as far as spending on capex, both from the government as well as infrastructure, as well as the private sector, is pretty high, and the portfolio is also very decent. Similarly, a diversified portfolio with a mix of both the worlds, which is stability from large cap and alpha from mid cap is something which the Premier League portfolio also presents. But we would like to ensure that we don't churn too much. I think the ideal would be maybe max of once a month, or when there is something which happens. Sometimes you have bought some stock, you realize it is not, there is some headwinds and you want to change, or even some other stocks where stocks have moved up so much. Like we had booked a mid cap IT company at the right time in the Premier League portfolio. So decent alpha, otherwise we will not exist, but at the same time, not too much of churn.
Before I take a couple of questions, Sunil, just wanted to tell all entire audience. I know there are certain clients in the audience, and there are prospects as well who wish to open account with Kotak Securities. If any one of you want to invest into any of these two Abacus portfolios, you have to select the small case section on post login section of kotaksecurities.com. You can log into KS and open an account instantly. It takes about 5 to 7 minutes, and there are 2 3 specific plans that we have. We've got a trade free plan for traders, and we have recently launched a plan which is for the under 30 population, where we do not charge any brokerage at all for a period of 2 years for a fee of 499. So anyone who is under the age of 30 can open an account and not pay any brokerage while investing into stocks. Sunil, a couple of questions that I have. One question which I see a couple of times is, what is the right time to invest into these two portfolios? अभी करने का कि थोड़ा रुक के करने का?
Sir, I don't have an answer, frankly. But I would say that the current correction has only increased our our return expectations. So before this correction, we were talking about 12 to 15% returns from the market. I think after the corrections, we are talking about a 15 to 18% returns from a 3 years perspective, as well as far as the markets are concerned. Today, tomorrow, very tough. But as I said, whenever I think the lows made recently, which was last week, should hold for a pretty long period of time. So maybe if you want to wait, at max maybe 3-4% lower, but you don't want to risk that 3-4% lower. As I said, if oil shoots up to 130, 140, you might get that opportunity. But on the other hand, if God willing oil falls sharply, then maybe you might not see those levels again.
Surya, I have one more question uh, on what China did yesterday. China had announced a 5 trillion stimulus package. Do you see any negative impact on India? Your views on commodity stocks like metals, mining, and whatever is related to the stimulus?
So, we have seen a good correction in global metal prices. And largely it's been a function of dollar movement. So when dollar was strengthening, obviously metals had their own perspective. And when the dollar weakened, you had metals which also had its own movement. I think as we speak, after falling by 10-15%, metals have consolidated. The reopening of the Chinese economy post the COVID lockdowns and the stimulus packages has led to slight increase in metal prices globally. And even crude has one of the reason of the crude price rise over the last 2-3 days has been because of that. Having said that, I think it is a welcome, I would say, indicator from a stock market perspective that central banks all over the world cannot be paranoid about increasing interest rates too much, because economies have still not come out of problems post COVID, and no central banks can tighten so much that you again face a recession kind of a scenario. On the metal front, I would say that we don't expect metal prices to fall further from these levels globally. As far as metal stocks are concerned, I think the correction has been more because of what the finance minister did in terms of export duty on steel. And that has definitely a potential of causing near-term headwinds to these stocks and sector, because profitability definitely is going to be impacted in the near term. Um, I would say that we would be investors in this sector. At the same time, by design, we don't go beyond 6-7% in metal sector, because these are very, very highly China focused, China dependent, and highly deep cyclical and very volatile sectors. And I think that stance we will continue.
Thanks, Sunil. Sunil, I have a few questions on stocks, but I will not take those questions with you. I आपको थोड़ा धर्म संकट में नहीं डालना चाहूँगा. But I'm thinking before just ending, two sectors for the future.
So I don't know how long the future is, but so see, we like the digital world, and as you rightly said, we can't live without it. Every day we have 2-3 parcels being delivered, and everything we are doing is now connected with the digital world. So I think keep an eye on that sector. I'm not saying go and buy everything today, but keep an eye on that sector. Hopefully, you will get good opportunities there. And the other for the near term is, I would say, rural focused consumption plays look very, very good from a 6-9 month perspective. Rural agricultural produce has been very good. Prices, soya, wheat, maize, oilseed, sugarcane, cotton are all very good. And after 2 years, the country is completely opened up. And as a country, we love to celebrate festivals and we love to spend on weddings. So between now and the festive season, I think demand scenario in rural India should be pretty decent. And hopefully we'll have again a good monsoon, and that should also cheer up sentiments.
Thank you, Sunil. And before we end, just wanted to share with all our audience that we have three dedicated Telegram channels dedicated on commodities, currencies, and equities, where we not just share the research ideas, we also give a lot of learning material, a lot of knowledge, a lot of discussions happen on that on those channels. So do subscribe to those channels to know more about all the segments. Thank you, Sunil. Thank you for sparing time, and I thank your team members, Chetan and Rahul, for sparing time as well. Looking forward to such sessions in coming times as well. I thank everyone in the audience for giving us a patient hearing. Thank you, everyone. Thanks, Sunil.
Thank you, and thanks for all your confidence and trust in Abacus team. Thanks a lot.